Every 6 weeks, a group of 12 people sit around a mahogany table in a marble building in Washington, D.C. They do not command armies. They do not write laws. But when they finish their meeting, stock markets move within seconds. Mortgage rates shift. Currencies adjust on the other side of the planet. Hiring freezes begin or end. The price of bread in Cairo, the cost of a car loan in Kansas, the collapse or survival of a government in Buenos Aires, all of it, in some traceable way, connects back to that room. These 12 people sit on something called the Federal Open Market Committee. And the institution they serve is the most powerful financial entity on Earth. It is not a government agency in the way most people imagine. It is not a private bank in the way conspiracy theorists claim. It is something stranger, older, and more structurally embedded in the global economy than almost anyone outside finance truly understands. This is the Federal Reserve. And the question at the heart of this story is deceptively simple. Who actually controls the world's money? To answer that, we need to start where the effects actually land, not in boardrooms or trading floors, but in ordinary life. Think about the last time you noticed the price of something jump. Eggs, rent, a used car. You probably didn't think about central banking. You probably thought about supply chains or corporate greed or bad luck. But behind every wave of inflation, every credit crunch, every period where jobs dry up or money feels worthless, there is a policy environment. Someone, somewhere, decided how much money would exist in the system, how expensive it would be to borrow, and how much risk the financial sector could afford to take. Those decisions don't come from Congress. They don't come from the president. They come, overwhelmingly, from the Federal Reserve. And yet most people have never been taught what it is, how it works, or why it has the power it has. That gap between the Fed's enormous influence and the public's thin understanding is not an accident. It is a feature of how the system was designed. Before we get to the Fed itself, we need to dismantle one of the most persistent illusions in modern life: the idea that money is simple. Most people think of money as a thing, a physical object, a dollar bill, a coin, a number in a bank account that represents something concrete. But money, in the modern world, is not a thing. It is a system, a network of promises, debts, and trust relationships held together by institutions, laws, and collective belief. The dollar in your wallet has no gold behind it. It has no commodity backing it. What it has is a government that demands taxes be paid in it, a military that projects power in its name, and a central bank that manages its supply. That last part, the management of supply, is where the real story begins. Because whoever controls how much money exists, how fast it moves, and how cheaply it can be borrowed controls something far more fundamental than currency. They control the tempo of economic life itself. So what is the Federal Reserve exactly? The short answer is that it is the central bank of the United States. But that phrase, central bank, hides more than it reveals. The Federal Reserve is not one institution. It is a system. At the top sits the Board of Governors, 7 people appointed by the President of the United States and confirmed by the Senate. They serve 14-year terms, longer than any president, longer than most Supreme Court justices in practice. The chair of the board, currently the most publicly visible face of the Fed, is appointed to a 4-year term but can be reappointed. Below the board are 12 regional Federal Reserve banks spread across the country, from New York to San Francisco, from Dallas to Minneapolis. Each of these regional banks has its own president, its own board of directors, and its own research staff. And here is where the structure gets unusual. These regional banks are technically owned by the private commercial banks in their district. Member banks hold stock in their regional Fed. They receive a fixed dividend. They participate in electing some of the regional board's directors. This is the detail that fuels 1,000 conspiracy theories. The Federal Reserve is privately owned, but this framing misunderstands what that ownership means. Member banks cannot sell their Fed stock on the open market. They cannot vote on monetary policy. They do not control the institution's decisions. The ownership is more like a mandatory membership fee than equity in a corporation. The real power, the power to set interest rates, to create reserves, to intervene in financial crises, rests with the Board of Governors and the Federal Open Market Committee, whose 12 voting members include the 7 governors and 5 rotating regional bank presidents. The New York Fed president always has a vote. That is not a coincidence. New York is where the money is. The story of how this peculiar institution came into existence matters more than most people realize, because it reveals the tensions that still define the Fed today. Before 1913, America had no permanent central bank. It had tried twice. The First Bank of the United States, the Second Bank of the United States. And both times, political opposition killed them. Americans were deeply suspicious of centralized financial power. And then came the panic of 1907. Banks failed. Credit froze. The stock market lost nearly half its value. The entire financial system was rescued not by any government institution, but by one man, J.P. Morgan, who personally organized a private bailout among New York bankers. The lesson was terrifying and clarifying at the same time. The country needed a lender of last resort, but the idea of giving that power to either the government or to Wall Street was politically radioactive. The solution, crafted over years of negotiation and finalized in the Federal Reserve Act of 1913, was a compromise, a hybrid institution, deliberately designed to be neither fully public nor fully private. It would have government-appointed leadership, but operational independence. It would be funded not by taxpayers, but by its own operations. It would serve the public interest, but be insulated from short-term political pressure. That compromise is still the architecture of the Fed today, and it is the source of both its extraordinary power and its persistent legitimacy problem. Because when you design an institution to be independent of democratic politics, you also design an institution that is, by definition, difficult to hold accountable. Now we arrive at the part of the story that changes how most people think about the economy. How is money actually created? The common image is a printing press. The government prints dollars, the Fed distributes them. Simple. Except that is almost entirely wrong. The vast majority of money in circulation is not physical cash. It is digital, and it is not created by the Federal Reserve directly. It is created by commercial banks every single day, through the act of lending. When a bank approves a mortgage, it does not go into a vault, pull out stacks of cash, and hand them to the borrower. It creates a deposit. It types a number into an account. That number is new money. It did not exist before the loan was made. This is what economists call credit creation, and it means that the money supply is not a fixed quantity controlled from the top. It is an elastic, constantly expanding and contracting web of debt. Every dollar of bank lending creates a new dollar of money. Every dollar of loan repayment destroys it. The Fed's role in this process is not to create the money directly, but to set the conditions under which banks create it. It does this primarily through interest rates. When the Fed lowers its benchmark rate, the federal funds rate, it becomes cheaper for banks to borrow reserves, which makes it cheaper for them to lend, which means more loans get made, which means more money enters the economy. When the Fed raises rates, the opposite happens. Credit tightens, borrowing slows, money contracts. This is the invisible lever. The Fed does not decide how much money exists. It decides how expensive money is. And that, in practice, shapes everything. The mechanism sounds abstract until you see it play out in real life. When the Federal Reserve lowered interest rates to near zero after the 2008 financial crisis, it was not simply making a technical adjustment. It was flooding the economy with the conditions for money creation. Cheap credit meant that corporations could borrow at almost no cost. It meant mortgages became more affordable. It meant that investors, unable to earn decent returns on safe assets like treasury bonds, were pushed into riskier investments: stocks, real estate, venture capital, crypto. This is the phenomenon known as the wealth effect, and its less discussed counterpart, asset inflation. When the Fed keeps rates low for an extended period, the prices of assets rise. Homes become more expensive. Stocks climb. The people who own those assets get richer. The people who do not, renters, young workers, those without investment portfolios, fall further behind. The Fed's tools are blunt. They do not target who benefits. They target aggregate conditions. And in a society where asset ownership is already deeply unequal, aggregate tools produce deeply unequal outcomes. This is not a conspiracy. It is a structural feature. The Fed was designed to stabilize the financial system, not to redistribute wealth. But the side effect of stabilization, over and over again, has been the concentration of wealth among those who already had it. This dynamic became impossible to ignore during and after the 2008 crisis, when the housing bubble burst, when Lehman Brothers collapsed, when the entire global financial system teetered on the edge of a cascade failure. The Federal Reserve did something it had never done at that scale before. It launched quantitative easing, QE. The mechanics of QE are often misunderstood. The Fed did not literally print money and hand it to banks. What it did was purchase massive quantities of financial assets, primarily U.S. Treasury bonds and mortgage-backed securities, from the open market. In exchange, it credited the selling institutions with new reserves. These reserves sat in the banking system, providing liquidity, lowering long-term interest rates, and supporting asset prices. Between 2008 and 2014, the Fed's balance sheet expanded from roughly $900 billion to over $4 trillion. Then, when the pandemic struck in 2020, the Fed did it again, faster and larger. Within months, the balance sheet ballooned past $7 trillion. The stated goal was crisis prevention. Keep markets functioning, keep credit flowing, prevent a depression. And by many measures, It worked. The financial system did not collapse, but the side effects were profound. Asset prices surged. The stock market hit record highs while unemployment remained elevated. Housing prices soared while wages stagnated. The recovery, in financial terms, was extraordinary. In human terms, it was deeply uneven, and this is the paradox at the core of modern central banking. The Fed's most powerful tools stabilize the system by enriching the parts of the system that are already the wealthiest. Every rescue over time compounds the inequality it never set out to create, which brings us to the question everyone wants to ask, but struggles to frame precisely. Who actually influences the Fed? The conspiratorial answer is simple: bankers, elites, shadowy puppet masters. The real answer is more uncomfortable precisely because it is more diffuse. The president appoints the board of governors. The Senate confirms them. In that sense, the Fed is downstream of electoral politics, but with a long delay because of those 14-year terms. Wall Street influences the Fed, but not through direct control. It influences through proximity, through the revolving door between the Fed and the financial sector, through the simple fact that the Fed's primary contact with the economy runs through banks and markets. When the Fed surveys economic conditions, it talks to bank CEOs, fund managers, and bond traders. Their worldview shapes the data the Fed sees. Academic economists influence the Fed through research, through staffing. The Fed employs hundreds of PhD economists, and through the intellectual frameworks that define what counts as good monetary policy. For decades, the dominant framework emphasized inflation targeting, central bank independence, and market confidence above all else. These are not neutral principles. They are choices that privilege price stability over full employment, credibility over experimentation, institutional continuity over democratic responsiveness. And then there is the market itself. Financial markets do not just respond to the Fed, they discipline it. If the Fed signals a policy that markets reject, bond yields spike, stock prices fall, and the resulting instability creates pressure to reverse course. The Fed watches markets as closely as markets watch the Fed. This creates a feedback loop in which the most powerful financial institution in the world is, in some real sense, constrained by the expectations of the investors it is supposed to regulate. No single person controls the Fed. No single group owns it, but a dense network of institutional relationships, intellectual traditions, financial dependencies, and structural incentives shapes every decision it makes. The power is real. It is just not where most people look for it. Everything we have discussed so far takes place within the borders of the United States. But the Federal Reserve's reach extends far beyond them. The reason is the dollar. The US dollar is the world's primary reserve currency. Central banks from Tokyo to Sao Paulo hold trillions of dollars in reserves. Global commodities, oil, gold, wheat, are priced in dollars. International debt, especially in emerging markets, is overwhelmingly denominated in dollars. This means that when the Federal Reserve raises interest rates, it does not just affect American borrowers. It pulls capital out of developing countries as investors chase higher returns in dollar-denominated assets. It makes dollar-denominated debt more expensive for governments that borrowed in a currency they do not control. It strengthens the dollar, which makes imports cheaper for Americans but crushes exporters and debtors abroad. When the Fed cut rates to zero in 2020, cheap dollars flooded into emerging markets, inflating asset bubbles from Istanbul to Jakarta. When the Fed reversed course and hiked aggressively in 2022 and 2023, those same countries face capital flight, currency depreciation, and debt crises. The Federal Reserve sets monetary policy for the United States. But because of the dollar's dominance, it effectively sets the financial weather for the planet. Countries that had no vote, no voice, and no representation in that marble building in Washington feel its decisions with devastating directness. This is dollar hegemony, and it is, arguably, the most consequential form of American power that most Americans never think about. So who controls the world's money? If you have followed this story carefully, you already know the answer, and you know why it is unsatisfying. No one person controls it. No single institution controls it. The Federal Reserve controls the cost of money in the world's dominant currency, but it does not control the money supply directly. Banks do that through lending. Congress could, in theory, restructure the Fed or strip its independence, but doing so would risk the very market confidence the system depends on. The president appoints the leadership but cannot direct policy. Wall Street influences the environment but does not dictate outcomes. Markets constrain the Fed constrains markets. And both operate within a framework of laws, norms, and expectations that no single actor designed and no single actor can easily change. The real answer is that money is controlled by a system built from crisis, negotiation, compromise, and institutional inertia. A system that is neither as conspiratorial as the paranoid believe, nor as rational as the technocrats claim. It is a machine built by humans, operated by humans, and yet so large and so complex that it often feels as though it operates beyond human control entirely. And perhaps that is the most unsettling truth of all. We live in a world where the most important economic decisions are made by institutions designed to be insulated from the people those decisions affect most. The Federal Reserve was built to be independent because its founders believed that democratic politics and sound money were fundamentally incompatible. That belief may have been right. It may have been self-serving. It is almost certainly both. But the result is a global financial architecture in which immense power is exercised by a small number of people who are technically accountable, legally constrained, and structurally unreachable by ordinary democratic participation. The world is not controlled by a mastermind. It is not run from a secret room. It is governed by systems so vast, so technical, and so deeply woven into the fabric of daily life that most people never learn to see them. And the most dangerous kind of power is not the kind that hides in the shadows. It is the kind that operates in plain sight, documented in policy papers and press conferences, and yet remains invisible because no one ever taught you how to look.